Let's bring in Ira Jersey into this conversation for the Best of Bloomberg Intelligence segment. He's our chief U.S. rate strategist over at Bloomberg Intelligence. And Ira, I was taking a look at some of the weekly moves that we've seen on the various parts of the Treasury curve. A few basis points here and there on the 2-year and the 5-year. But then you get out to the 10-year, and you're seeing something like a 20 basis point move. On the 30-year, a 30 basis point move. And that's basically a flip-flop of kind of what we had been seeing on a week-to-week basis back in August and at the start of September. What gives?
Yeah, I think a big part of this is just positioning and a lack of liquidity. So the positioning is that a lot of people have been in yield curve flatteners, and quite frankly, I've been espousing them for the better part of a year as well. Just the idea that long-end interest rates ultimately will continue to do better than short-term interest rates. But that seems to be a very crowded trade. A lot of people are in that position. And then when you get people unwinding those positions and then stops getting hit on top of that, you just see these massive moves. So you look at 2s, 10s moving 10 basis points in a day. That's not something that the market typically digests. And I think that the single biggest reason for that is just how big the market is and the trading volumes versus the liquidity providers being able to take and warehouse some of that risk. And it's that disconnect is just creating a lot of volatility in these markets.
We have heard Janet Yellen, we've heard from Lael Brainard, regulators and thought leaders and market participants about the illiquidity at the moment. But are we hearing more and more about how to fix it? Does it need fixing eventually, Ira?
Well, I think it does need fixing. The problem is that any of the fixes that need to be changed are not palatable to a lot of regulators. So it's things like changing the supplementary leverage ratios and some of these other Basel rules. So basically, banks and dealers can't increase and decrease the size of their balance sheets fast enough for the flows that are coming in from the government bond markets. And to be frank, it is imperative for governments to want to have a deep and liquid government bond market, because it is the way that they fund themselves, number one. And number two, it's the basis for every other fixed income and every other financial security in the world. And as you mentioned, it is the credit risk-free. They're not risk-free assets on a mark-to-market basis at all, but they are credit risk-free insofar as the government's not going to default on the debt. But that being said, if the Treasury market is so volatile, then that just means corporate bonds are super volatile, and that feeds into much more financial assets and makes it more and more difficult for investors to take long-term risk.
And it raises a lot of questions here about what the U.S. government is going to do or whether it should do anything. We know Yellen has kind of reiterated this idea of letting sort of market forces do their thing rather than any sort of intervention, whether hard or soft. But we'd be remiss, Ira, in not asking you about some of the moves that we've been seeing by the Bank of Japan and other Japanese agencies, whether it's the currency intervention or a lot of discussion, a lot of speculation about whether the Bank of Japan sticks by some of those yield curve control caps that they have in place when they meet at the end of next week here. The idea that maybe if they loosen that could potentially tamp down some of the FX volatility.
Yeah, I think that could certainly tamp down on some of the foreign currency volatility. But for global rates markets, I think one of the reasons you're seeing the long end of the Treasury curve and the European bond market and gilts, all of that move today is the idea that the Bank of Japan could get rid of yield curve control. And in doing so, that probably means that 10-year Japanese government bonds yields can shoot higher from 25 basis points to 75, 100 basis points. Because what you've seen in Japan is a very significant steepening of their yields curve. So the difference between the 10-year Japanese government bond and the 30-year is now over almost 150 basis points. And the reason for that is not that people expect the Bank of Japan to increase interest rates massively in the next 10 years. It's more that that you can trade 30-year bonds and sell them, whereas you can't do that with the 10-year because the Bank of Japan is just buying everything in sight at 25 basis points. So so I do think that there could be a lot more volatility to come if the Bank of Japan gets rid of yield curve control.
And overall, this all speaks to a difference in central bank policy and the fact that rates have such a huge gap between them, between Japan and the US. What did you make, therefore, of coming back to US central bank policy? Mary Daly and the like starting to talk about a future where we have smaller rate hikes. Are they starting to look at the data and think that we need to start having that conversation, or not yet?
Well, I think we're at a point, and the market keeps on gyrating and caring about whether or not they go 50 or 75 in December. Like that's all the big talk today. But at the end of the day, from my standpoint, is I think it would behoove the central bank maybe to get some of that out of the way and say, hey, we're going to start going in smaller increments, but we might go further if the data tells us we have to, right? Because one of the worry that the Fed has is that they go too far and they force a recession, but they really fear inflation becoming super sticky. So they can't do, they want to make sure that they go far enough that inflation and inflation expectations really come down quite significantly, and they don't become embedded in people's psyches. So I think at this point, it actually makes a lot of sense for the central bank to start talking like, hey, we're going to go 75, and then we're going to go 50, and then 25, and then maybe 25, and maybe 25, and maybe 25. Like that's, I think, the talk that they have to get to, because they can kind of fine tune where the ultimate peak in the Fed funds rate is.